Hello, and thank you for joining us on our webinar today. I'm Angela Strangman, and I lead the marketing efforts here at TrustPoint. Before we jump in, I just want to mention a few items. We will be recording this webinar and sending it out as we have done in the past with our webinars. We are probably going to take maybe a few days to get that recording sent to you, but a link will be sent via email. We also we have recorded our past webinars, and those are all located on our website as well at www.trustpointinc.com. That is the same place that you can go to find our latest articles and our latest market updates, as well as information on topics like the CARES Act or planning opportunities. We also are pretty active on our social media channels, and so if you haven't had a chance, we do invite you to check out Facebook, LinkedIn, Instagram, and even YouTube, so you can stay up to date with everything that we are sending out. In order to maximize your viewability of the webinar today, I do want to just ask that you adjust the settings on your personal device so that you are prominently seeing the slides that are displayed. You'll see myself, Jan, and Randy off to the side right now, but we will be stopping our video during the presentation, and then we'll pop back in during the Q&A session at the end. So this webinar is just a little different than what we have done in the past. Besides just seeing our faces, we did it more as a Q&A session and more of a discussion, more of a question and answer and a discussion. So for everyone who had submitted questions in the last couple weeks, we appreciate that. And we started the presentation with those questions. But you are also able to ask questions of the panelists during this live event. So if you use the Q&A button at the bottom of your screen, you can submit those questions. Of course, we're going to try to get to as many questions as we possibly can, but not sure with timing if we'll be able to get to all of them. So of course, you can at any time, if your question isn't answered or you have further follow-up questions, please feel free to reach out to your relationship manager or just our general email at info@trustpointinc.com. Our offices at TrustPoint do remain closed as we continue to evaluate the situation, but we are available for phone conferences, video conferences, or just an email discussion. So we will get you the answers if you have the questions. So with that, I would like to go ahead and get this webinar started. And I first want to introduce my colleagues. So Jan Arsenal and Randy Van Rooyen are two of our senior investment experts. Thanks for joining me today, guys.
Thanks for having us.
Thank you.
All right, and the first thing we're going to do is we are going to try to pull up a poll question that we'd like to get your answer on. So give it just a second to pull that up. All right. And as you're reading that, I'm just going to give you a second to read the question and give us your response. And as you're finishing up there, I just want to talk through what we're going to cover in the next 30 to 40 minutes here. We're just going to, based on your questions and answers, like I said, we are going to look at the journey of the market, where we've been in the last couple months and what that means for portfolios. We're also going to discuss the reopening of the economy and what impacts that has, as well as look at the road to recovery. And again, at the end, if we do get some Q&As in, or questions in, we will attempt to answer those. So with that being said, we will come back to the results of this poll, so we can go ahead and close that poll. And Randy and Jan and I are going to go off video for just a second. You'll still hear our voices. And we'll go ahead with the first question. Okay, so Randy, this one is for you. The economic data as of late has been pretty rough. Can you, however, the equity markets have had a nice bounce off their lows. Can you elaborate on that and talk us through and explain it a little bit more?
Sure. Thanks, Angie, and thanks for everybody for joining us today. Yeah, it's true. The data reflects the economic shutdown caused by the COVID-19 pandemic. As we consider the rebound, it might be helpful to first look at where equity markets came from prior to the spread of the virus. What you're looking at here is a global equity benchmark back to the beginning of 2019. And just prior to this, you may recall that the fourth quarter of 2018, equities experienced a sharp sell-off. And they really centered around a few concerns, that existed. First, the Fed and how aggressive they were with raising rates, going too fast, going too high. The trade war heating up with China, and then generally speaking, slow and uninspiring global economic activity. As we entered in 2019, as you can see from the graph, it didn't take long to actually get back to near all-time highs at that point, and that really by April, we saw the market move and rebound from the recent all-time high in 2018. But from there, the middle 2 quarters of the year, we really grappled with, or the markets grappled with, the trading negotiations, on again, off again type of headlines, only to have by the beginning of the fourth quarter to break through the all-time high and really set all-time highs throughout the fourth quarter. Now, as the virus spread, equity markets did sell off. And it was a rapid sell-off that took less than 4 weeks. And from peak to trough, we saw about a 34% decline. Now, from the past, we know that average market declines associated with U.S. recessions average about 35%. So although there's nothing average or common about the economic impact the pandemic has caused, the market decline has been in line with other recessionary environments. Now, it's a lot easier talking about this today. And that's because, as Angie mentioned, the rebound that we've seen so far. There's a lot of names for this: a bear market rally, a retracement rally, just a really solid rebound. But nonetheless, it's been impressive. It's fairly common to see in these types of downturns about a third retracement, a third of the full downturn in the market to be recouped. But that usually takes about several quarters. And from what we've experienced since March 23rd, the low that was put in, we've retraced about 50%. This is the global benchmark, and actually the U.S. A lot of the U.S. benchmarks or indices have retraced about 60% of the decline. And rather than taking several months, it took less than 2 months. Now, back to your question, why is this happening? Well, we know that the market looks out, tends to be about six to 9 months. And even though the economic data released today is horrific, markets really care about what it's going to look like then in 6 to 9 months. With that said, the market seems to be pricing in a perfect reopening of the economy. Any delays, any deviations, we may see a resurgence in volatility. Other contributing factors that you may see headlines on are the large tech stocks keep winning and driving markets higher because they make so much of that benchmark. Improvements in progress in fighting the virus have also helped move markets. But from our perspective, the most important was the early, aggressive, and open-ended response from central banks and governments, especially here in the U.S.
Yeah, and Randy, I'll jump in here. I think you're absolutely right. You and I certainly agree on this. The Fed has been really responding quickly here to this crisis. And what we saw really on the next slide is the Fed really dusting off the alphabet soup of programs created during the financial crisis, but they have also come up with a bunch of new ones as well. And interestingly, as you look at the chart here and you focus on the red dots, at this point, the Fed hasn't had to do very much at all. And that is interesting. It just shows the power that the Fed has, not only in the actions that they've taken, but in the words that they have shared with the investment community. What we have seen, in fact, is private market participants coming in and filling the gap that the Fed intended to fill in the first place. And private market participants at this point are willing to provide liquidity. They're willing to provide credit to households and businesses in need of cash because they understand that the Fed has their back. So The Fed has certainly been successful in the actions that they've taken so far. But as Randy mentioned, the federal government has also been stepping in here to make sure that struggling households and businesses have enough cash to meet their financial obligations. And that is shown on this chart here. If you look at the red portion of the chart, it shows what the US government has done in a matter of a few weeks in terms of stimulus. And obviously the CARES Act was the most recent piece of legislation passed by Washington, a $2.4 trillion package. We know that the Democrats have already moved forward with another $3 trillion package, which has been called dead on arrival, upon arrival in Washington. But we know that the federal government has been willing to step in here. So when it comes to both the Fed and the federal government, their quick, significant in size and open-ended commitment has really been tremendous here.
So I have a question that we received from actually a number of our clients, and just, you know, with all this information that you shared, have we hit bottom?
Yeah, that's a good question, and it's hard to say, but I think it's important to know. It's very common for markets to revisit or retest market lows before moving on. It's really part of the bottoming process that's actually healthy for the market, and philosophically it offers a stronger foundation to build off of. With this significant of a rebound, we may not see the lows set again, but as investors, we should expect more volatility as this unfolds. I think it's fair to say that the possibility of revisiting lows increases if the economy has to close, reopen, and a deeper, longer recession develops. But that's hard to say right now, but that's what we're working through, and we'll have to watch how that unfolds.
Sounds good, thank you. So is there any risk in selling equities now and just staying in cash and high equity bonds exclusively until this is over?
Yeah, good. Another common question. I think that's the challenge with investing. There's always risk involved, even risk of being in cash and in bonds and missing out. So, you know, I mentioned earlier the market's focus looks forward. It's forward looking. They often tend to climb the wall of worry. Historically, market declines associated with recessions have created amazing buying opportunities. Of course, hindsight's 2020. I believe the decision to sell equities is easier than the decision to buy back in. Now, this is because when the environment looks the worst, that's probably the best time to buy, but it's very difficult to make that decision. By the time we're through this, the stock market will be well into another rally mode, and rebound returns are an important part of long-term returns.
Absolutely, makes sense. Thank you. So this was a client question that came in. Many experts say equity valuations are too high. Any concerns there?
Yeah, good question again. I think you have to be a little concerned about valuations at current level. Now, what you're looking at here is the price earning ratio for the S&P 500 in the black line, and the green line would be the same price earning ratio for the world equity benchmark. And no, really, you have to go back to 1999, 2000 to see similar valuations. Obviously, back in 1999, 2000, valuations got a little higher, but we know how that ended. So now, interestingly, now we're looking at the PE ratio here. We look at a number of other metrics to get a feel on valuations, and I would say that across the board, our indicators are telling us that equities are probably fairly valued at best, and probably a little too rich in most cases. And what we've seen recently is a steady really decline in earnings estimates, earnings expectations, which are normally negative for stock prices. What has been offsetting that is, I think, the belief that interest rates are going to stay low for a long period of time. And as a result of that, the discount rate applied to future earnings will stay low for quite some time, boosting, as a result, equity prices. So that's the battle kind of going on right now in the marketplace. But as Randy mentioned, I think earlier, no, the market equity markets at this point are probably pricing in a best case scenario, a V-shaped economic recovery with no real setbacks. And we think it's going to be a little bit more complicated than that. So for now, we are maintaining a cautious approach towards equities. We're not sellers of equities, but we're not buyers either. And we have maintained a cautious allocation to equities really since the fourth quarter of last year. So we're in a good position here to add to equities. But again, at these levels, we're not willing to do that.
Great, thank you for that, Jan. So how about the bond market? With yields low, do bonds provide value in portfolios?
Yeah, I think they do. Bonds play an important role in a portfolio. They offer stability. They support the portfolio in challenging times. Bonds also provide income and potential source for cash flow when other parts of the portfolio are devalued. With that said, the high quality investment grade bonds have experienced impressive rally over the last 6 months, really leaving this area of the fixed income market, as this chart indicates, with historically low yields and as well as a little bit higher risk with longer duration, as seen in the upper right hand corner. We will likely need to look beyond the investment grade market and specifically into the non-investment grade at some point. Things like high yield bonds, convertibles, and senior bank loans might make sense as conditions improve. These are all asset classes that we've used in the past, but haven't had exposure to really in the last several quarters.
Okay, Randy, you did mention corporate bonds, and we had a few questions on that. Can you elaborate on that a little bit more and what we're looking at in portfolios in regards to that?
Yeah, I can certainly jump in here. Now, as Randy mentioned, the high quality bonds, especially the long duration bonds, and when we say high quality bonds, we typically refer to government and agency bonds. Now, I've seen a tremendous rally as of late, and as a result of that, we're not seeing much value there, but we are seeing some value in the corporate bond market. In the US in particular, if you look at the chart here, it shows that 71% of the time, corporate bonds in the US have been more expensive. So we are seeing value in corporate bonds. We know that corporate bonds also benefit directly from the Fed's support through some of their programs. And corporate bonds also tend to do well during recessionary periods and also in the early stage of economic recoveries compared to equities, for example. So we like corporate bonds. We also like higher quality, high yield bonds at these levels. And we've been buyers of both asset classes or sub-asset classes, I should say, as we speak.
Okay, we did have a client question that this seems about the right place to ask this. So what about the muni bond market where we have seen some turbulence as of late? Is this still a good place to invest?
Yeah, I'll take that one, Angie. Yes, we think so. I mean, muni bond market has had to deal with some headline risk from the political environment. However, default rates are extremely low, and relative to high quality taxable bonds, munis provide an attractive taxable equivalent yield. To give you an example, historically, municipal yields tend to be about 85% of their tax equivalent treasury. Well, today, muni bonds are often offering about 150% of the equivalent taxable yield of treasuries. So very attractive from that standpoint. We see this as a good option for clients that would benefit from non-taxable income.
All right, great. So I think we're going to bring up the poll results. And as I know Jan has talked about this over our last webinars, but in the next several months, how the markets and economies perform will be in large part on how we adjust and how we adapt until a more permanent solution for COVID-19 is put into place. I want to elaborate on that, but maybe we just take a look at the poll results.
Yeah, so this is very helpful, and it really is going to coincide with the next part of the presentation. So I'm going to stop sharing here and take a look at a poll, a very similar poll that was taken. So we think this is among the questions that need to be answered to help give us a feel and consider the economy's ability to improve and get back on track. You know, what's challenging is that this is not the same for all regions, states, and cities, and we've seen a lot in the headlines the last couple of weeks. You know, perspectives from different areas around the U.S. are different. I mean, in a rural county in Minnesota or in Wisconsin will be a lot different than New York City. But on aggregate, will consumers resume some sort of normalcy, and when will that happen? So looking at the results of this survey on the slide, it's clear that attitudes will need to change. When asked, are you nervous about leaving your home or if businesses reopen and travel resumes? You can see from different countries the results, and the majority of the country's respondents are nervous about leaving their homes. Now, this is a smaller sample, and it was a month ago, so certainly could have changed since then, but it still will not only be the ability of consumers to return to some type of normalcy, but their willingness to go out and be a part of the recovery in the economy.
Yeah, so Jan, maybe what, I know you've talked about this in the past too, but what is going to make people confident? Is it just the vaccine? Is there other things that will make them confident in returning to their normal lives?
Yeah, I think the vaccine will certainly go a long way. I think everybody's looking for that. What we're hearing is that it should be available in 12 to 18 months if everything goes as planned. You know, we've heard reports that we may get a vaccine as early as the fall for maybe healthcare workers, but now historically it's taken a long time to come up with a vaccine that can be, mass produced and mass distributed. So I think we're going to have to be a little patient there. Obviously, herd immunity could also do the trick, but we may have to wait 2 to 3 years. I don't think we have the patience to wait 2 to 3 years. This is the concept where you have like 70% or so of your population immune from the virus because they've already got it and built immunity to it. So the reality of it is that we're 4 months into this, and there's still a lot that we don't know about the virus. And as our poll shows, and as the survey that Randy was just showing shows as well, the virus has not gone away, and people, I think, understand that. And as a result of that, as we've seen, a little fearful about returning to the normal lives.
And these charts and graphs are from the U.S. How does that compare to outside of the U.S.?
Yeah, so let me just talk about the situation in the U.S. first, Angie, and I'll address the question that you're asking. What you're looking at here on the left-hand side is a chart of the daily new cases in the U.S. What you're looking at between the two red vertical bars or lines are the stay-at-home order start dates. And obviously, we've put these stay-at-home orders in place to flatten the curve. And we have managed to do this. Although when you start dissecting the data and you look at the data on the right-hand side of the page, now what it shows is that outside of New York and New Jersey, we haven't really seen the flattening of the curve. Now the chart on the right-hand side here is about 12, 15 days old. I actually saw this chart just about an hour ago updated from one of our research providers, and it shows that there's a flattening even now outside New York and New Jersey, but certainly not a decline in the number of new daily cases. And I think that's important to know because people are talking already about the possibility of a second wave, when in fact, when you look at the numbers here, no, we haven't really managed the first wave of it yet. Outside the US, to address your question more specifically, Angie, we're seeing similar trends in the sense that in Europe and in Asia, we've seen good progress when it comes to controlling and managing the virus. But we're seeing new hotspots developing outside Asia and Europe and the US as we speak. Russia has been mentioned a lot recently. And in South America, we know that Brazil and Peru as examples are currently dealing with the virus. So again, back to what we were saying, originally the virus has not gone away, and as we reopen our economy here in the US, we're gonna have to be careful.
Sounds good. And we know, I think the states that have reopened or have some form of reopening is up to 49. What are your thoughts about that reopening and how that how the curve is impacted then?
Yeah, so on the next slide, what we're showing is the guidelines provided by the White House just a few weeks ago to try to help state governors in their process of reopening their states. And what the White House said is that this should happen in different phases. And before you get started about thinking about reopening your state, you should have two important gating criteria in place. One is a downward trend in the number of new daily cases for at least 14 days, which is believed to be the incubation period for the virus, and robust testing as well. Now, if we look at the chart on the next slide, this is also about 10 days, a little bit more than 10 days old now. As Angie mentioned, more states now have reopened. So the states that have reopened would be the ones in green, and the ones that are a little darker, in darker green here, are the ones that have reopened without meeting the gating criteria. And we know that Georgia was the first one about 3 weeks ago to reopen, and they were criticized for doing that. So this is a giant, I would call it giant national experiment we're going through. We believe that we're going to have setbacks along the way. We're going to believe that we're going to see new hotspots developing, but so far the news is pretty good. In the case of Georgia, for example, we haven't really seen after three weeks a renewed spike in cases. From a testing standpoint, I think we are getting better at this. From a tracing and isolation standpoint, I think we still have a little bit of work to do here. So hopefully everything goes as planned, but we would say that for the most part, yes, some states have maybe reopened a little faster than they should have.
All right, thank you for that, Jan. So we do get a lot of questions just asking when will this all be over? And of course we can't answer that, but we do have an idea of what we think the road to recovery will look like according to the economy. So do you want to talk a little bit about that?
Sure. So maybe before we talk about the recovery, we should maybe talk a little bit about the recession we're in. And the IMF came out with their forecasts not too long ago, and they believe that global GDP will contract by about 3% in 2020. And this is shown on the chart here. If you're looking at the black line, you see a 3% contraction with the bottom in economic activity probably happening in the late first quarter, early second quarter of this year. Now, the red line scenario and the green line scenario on the chart here are two scenarios that we probably don't want to talk about. They are scenarios related to potential new outbreaks in the fall, which is certainly a real possibility, or a scenario where we have trouble really managing this first wave we are going through right now. The recovery phase of this, we believe, we call it the swoosh and wavy recovery for two reasons. The swoosh part of it comes from the fact that economic activity declined really quickly in the last several weeks. Then we are seeing a sharp rebound as we're reopening states. And then after that, we believe that growth will continue to be positive, but it's going to be more of a flatter pattern, if you like. So think about the swoosh as the Nike logo and what it looks like. It gives you a sense for what the recovery is going to look like. And the wavy part of it, which is not shown on the chart here, which we believe will be part of this process, is this idea again that we have renewed regional lockdowns as we see periodic spikes of infection in different pockets of the US or even outside the US. So the reality of it is that we're getting better at this. Now testing is getting better, tracing hopefully will get better, and we are having more and better treatments for people that are sick. So we're gonna get out of this, but it will take some time.
Sounds good. Thanks, Jan. The Fed Chairman, Jerome Powell, had recently said that the virus could leave permanent scars on the economy. Can you elaborate on this?
Yeah, the long story short here is the longer it takes for the US economy and the world economy really to return to normalcy, the greater the risk that liquidity issues that are currently being faced by households and businesses, their inability maybe to pay their bills, turn into solvency issues. And as we talked about earlier in this webinar, the Fed and the governments have stepped in really to help businesses and households meet their financial obligations short term. But over time, if this drags on for a period of time, we may see more bankruptcies. We haven't seen a whole lot of bankruptcies at this point in time because, again, of the actions of the government and the central bank. The other thing that is important to mention is the fact that we've also seen a lot of job losses, but these job losses are, for the most part, temporary job losses. We don't want those to turn into permanent ones. And again, if that drags on for a while, they may turn into permanent ones. So for now, again, because of the action and the open-ended commitments of central banks and governments around the world, and especially in the US, no, we don't think that we're going to have permanent scars, but we believe that the recovery will take some time.
All right, so just to be clear, the swoosh and the wavy is not Randy and Jan's newest dance craze. It is our description of the recovery, right?
That's why we turned our videos off, yeah.
I'm only kidding, of course. You two have been doing this for a very long time, and you've seen a lot of research. My question to you both is, what economic data has surprised you the most?
Well, maybe I'll start first. The first thing that comes to mind for me is not really an economic data point per se, but it's how really people reacted to this by stocking up on everything, including toilet paper. Now we are not seeing that anymore, but I think there was certainly a surprise to me at the onset of this crisis. Now, what we have seen when it comes to the data itself is the fact that it's been poor across the board, and it shouldn't be a surprise to anyone. Now we have really inflicted this recession on everyone. So I don't know, Randy, maybe something comes to mind for you.
Yeah, no, I agree with you, Jan. If you went back 3 to 4 months and consider where we were then, everything we're seeing today is quite surprising. Maybe on the lighter side, they had the why the toilet paper hoarding, but it comes to mind that even though it seems a little disheartening to see gas prices so low, but I don't need to buy any, so it's also a little bit of a head scratcher there. But nonetheless, I'd say that it really is the numbers that are coming out are certainly some of the worst we've seen in some cases from GDP growth and unemployment in such a quick time, but also being associated with the more health issues. It does have the ability to rebound maybe quicker than other recessionaries that were caused by economic conditions.
All right, great. So we're gonna switch gears. We had a lot of questions on financial plans and planning opportunities. So Randy, maybe this one for you. How should financial plans adapt to the current environment, especially for people who may be close to retirement?
Yeah, that's a very good question, and it's a natural question. So, the bottom line is we don't believe that there's a need for significant changes. Nobody wants to see account values decline. I mean, I get that, but we know that we're going to have bear markets, and we know that we haven't had a bear market in over a decade. The bottom line is the work was put on the front end. Objectives were determined correctly. Cash flow needs are understood. Significant changes are needed. And maybe take this particular survey as evidence. As you see here, most Americans haven't touched their investments amid virus-fueled market volatility. So, given these 4 responses at the bottom, contributing more to investments, moving money out of investments, intentionally doing nothing and wasn't aware of the volatility. You know, a good example of ignorance is bliss. You'll see that only about 10% responded with moved money out of investments. So very small fraction. So, and if you think about what we started with, the graph of the market, that's a good thing. This survey is a little bit dated, but it's right around the bottom of the market. And if those people that didn't do anything with investments certainly were able to benefit from the significant rebound that we've had. So really, what can be done? We know we can't control the markets, but we can control how we react and maybe make the best of the situation. So just a couple considerations. You know, discuss with your relationship manager cash flow management. It's so the immediate needs or immediate spending needs are understood. Most portfolios have exposure to fixed income, so there's likely assets to draw on to minimize negative effects of longer term performance. And then also review spending habits. It's not a bad time to tighten your belt. Maybe postpone larger expenditures. These are the types of conversations we're having with various clients. I'd say by and large, our clients have weathered this extremely well. Our conversations have been positive and constructive. So I guess I just want to take a moment to applaud all of you for taking on these challenging times and really maintaining a long-term perspective. And you know, you can see from the survey that you're not alone. Many people reacted the same way.
Absolutely. Good comment, Randy. So we had in our last webinar, we did talk about some planning opportunities, but now maybe it's a good time to talk about those again. What planning opportunities could clients look for right now?
Yeah, we really have focused on that in a lot of our communication, but I think it's important to review it and remind everybody. We've been very active with several strategies, and you know, the most common, just a few of them, is the tax loss harvesting, the idea of taking losses to offset future gains. Roth conversions, you know, converting some of the IRA assets when values are low, so then minimizing the tax consequences. Portfolio transitioning has also been accelerated in many cases. And then I'll throw in also, because of the CARES Act, discussions around RMDs. And we, you know, with the CARES Act, the RMD is not required this year, but everybody's situation is different. So I encourage everybody that if you are at the age of RMDs, you have that discussion with your relationship manager. But all of these are designed to focus on what we can control, and that's real important to do in this environment.
Absolutely. And I would just say, as a follow-up to, I mentioned it before, but we do have that recorded webinar out on our website, as well as some articles talking specifically about planning opportunities as well. So you could take a look at that. So that about wraps up the questions. We have had a few questions that have come in, and I'm going to try to get to a few of them now. If one of you would want to take, and I think we're going to turn our videos back on so you can see us. There we go. All right. Could we see negative interest rates? And if so, should cash be kept?
Yeah, I'll take that one. You know, we've seen this in other countries and negative interest rate policies being put in place. And over the last few years, you know, what about the U.S.? And here's what we know. As recent as last week, Chairman Powell said that negative interest rate policy is not being considered at this time. You know, now if we see a renewed panic and several series of bad news, we could push rates lower, and certainly on the short end, we could see negative rates. But also, we've heard a lot from Fed Chairman Powell that even if rates do go negative in the short end, he doesn't see them consistently staying below zero. You know, we believe this because we believe the Fed won't do this because other central banks around the world that have done this, meaning, you know, Europe and Japan, they haven't achieved the outcome that was desired. So with that said, we know that the Fed can pivot and change their policies, but we don't think that that we're going to see that for any extended period of time. And we don't think we need to go and store cash. Keep in mind that when we talk about negative interest rates, we're talking about government issue bonds. There's other areas of the market that may not see the same type of decline, especially into negative territories. So there's still areas to get a yield on your fixed income investments.
And have other countries experienced the negative interest rates? And can you talk a little bit about that?
Yeah, they have. And over the last couple of years, again, Europe comes to mind and Japan for extended period of time have done that. And really, again, the idea there is to stimulate the economy, help money flow and boost the economy. But, certainly in Japan is still are a little bit stagnant and in Europe as well. So there has been, it's a policy decision by central banks to do that as stimulus. But, again, here in the U.S., Paul's went as far to say that there's other things they can do well before adopting negative interest rates that they believe will be more effective.
Sounds good. And another question, with all the money government spending, should we see inflation, an increase in inflation?
Yeah, maybe I can take that one. Now, we got that question a lot following the 2008-2009 credit crisis, where we also saw the Federal Reserve and the U.S. government really stepping in to help the economy, maybe with a lag, maybe not as much as we would have liked them to do at that time, but people were talking about the possibility of inflation as a result of, again, aggressive monetary and fiscal stimulus. So we are 10 years later, now looking at the data, and really over the past 10 years, we haven't had to deal with high inflation. So it didn't pan out. Will this time be different? Short term, I would say that the sectors of the economy that have been most impacted by this, we'll see a deflationary environment. Think about travel and hospitality and apparel, for example. But longer term, it may be a different story. And longer term, I know businesses have already started to think about what their supply chains look like going forward. And the trend towards deglobalization may accelerate as a result of the crisis we're going through. So longer term, we may see more inflation. The good news is that the market is currently not pricing in a whole lot of inflation as we speak. So if we do get more inflation than is expected, our portfolios are well positioned for that. When we look at forward inflation expectations, they are running just above 1%, when in fact the Fed is targeting something closer to 2%. And we think that eventually we're probably going to get back to a 2% kind of level of inflation.
Okay, so I'm just going to take maybe a couple more questions here. Jan, just to clarify the swish and wavy recovery, can you talk through that again? We don't have the slide up, but just to make sure that people understood, I had a question on if you are supporting swish and wavy, and when do you think the economic growth in the U.S. will occur?
Yeah, so again, when we refer to the swish, we refer to the Nike logo. So a quick drop in economic activity, a quick rebound that will follow reopening of different states in the US. And then after that, now we have to build that confidence in the system. We saw the result of our own poll. We saw the result of the survey that Randy was showing. Now people have to feel comfortable that things will return to normalcy. And we think it's going to take a little bit of time, and it will need a vaccine. And the wavy part of it is this idea that, again, we may get renewed lockdowns in the US, outside the US, as we see new hotspots developing. Again, this is the idea that we're going to get setbacks along the way. It's not going to be a straight recovery up to where we were just before this all started.
Absolutely. So again, we have a few more questions, but we're going to try to wrap it up. We will have, we're hoping to have host some future discussions and webinars. But thank you for joining us today. As always, we want to encourage you to check out our website, check out our social media channels, but also reach out to your TrustPoint contact. And if you have any follow-up questions, they would be happy to discuss those with you. But until we can see you next time, take care and have a great day.